Imagine a retirement where you get to travel the world, pursue your hobbies, live comfortably, all without worrying about taxes eating away your savings. Sounds pretty good, right? Well, the good news is it's achievable. And in today's video, I'm going to share with you 3 simple strategies: Social Security optimization, tax gain harvesting, and strategic income shifting, all of which can help you save significant amount of taxes in retirement. Let's jump in. Number 1 is Social Security optimization. Well, how on earth is Social Security optimization helping to save money on taxes? I know it's good for income. I know it's good to help me increase my income floor, but what does that do in terms of its impact on my tax bill? Well, let me show you. Let's assume you and a spouse both take Social Security at age 70 and you both have the max Social Security benefit. Now, I know this is rare. Most people don't have 2 spouses that both qualify for max benefits and both wait until age 70. So I'm not showing this for the actual numbers as much as the same principle that's going to apply regardless of your actual Social Security benefit. That being said, in 2024, if you did fully max out your Social Security benefit and waited until age 70 to take advantage of delayed retirement credits, your benefit on a monthly basis would be $4,873. Now, if you take that over 12 months, that comes out to $58,476 over the course of a year. If 2 spouses are getting that, then that's $116,952. So quite a bit of income. And again, this is both waiting until 70, both with a max benefit and the combined income of just under $117,000. Let me show you what that looks like, and let me show you how that same amount of income coming from an IRA or a different income source might be taxed. So here's what we're looking at in this scenario here. Scenario 1, all Social Security. What we're saying, and I know this isn't exactly how it happens, but I'm trying to illustrate a point here. What if you had 0 other income sources? No wages, no interest, no dividends, no IRA distributions. All you had was $116,952 in income, the entirety of which came from Social Security. Well, if we were to run a tax report on that to see what would that look like for you personally, what that looks like is this. Your total income, your adjusted gross income, would be $18,305. And you're saying, wait a minute, I thought you said the income's close to $117,000. Well, it is. And to be precise, it's $116,952. But the portion of Social Security that's included in your actual adjusted gross income comes down to something called your provisional income. Your provisional income is the way that Social Security is calculated. So they say, what's your provisional income? And based on that number, anywhere from 0 to 85% of your Social Security benefit will actually be included in your taxable income. Even if you had the max Social Security benefit, like this hypothetical couple does here, only $18,300 of that is actually included in adjusted gross income. Meaning that once you take a standard deduction, so for 2024, both these individuals are over age 65, obviously, because they're collecting at 70, their standard deduction would be $32,300. That would cancel out any adjusted gross income. So in other words, their total tax at the federal level is $0. Let's assume this couple's in California, which is where I am. Well, California does not tax Social Security benefits either, nor do many other states. So effectively, this couple has $117,000 of income where they're paying $0 in federal taxes plus $0 in state taxes for a total, of course, of $0. That's pretty attractive, right? Well, keep this number in mind, $116,952. What if we go back to this projection and insert scenario number 2, we said, what if that same exact amount came to them, but now it came entirely from a traditional IRA? What did I do? Well, you can see here, IRA distributions, $116,000, Social Security, 0. As a side note, I know this is not realistic. Typically, people are taking both Social Security and IRAs. There's never an instance where it's either one or the other, but just illustrating a point here. If all this income came from their IRA, and we ran a tax report on that as well, now all of a sudden, what you'll see is their total tax at the federal level is $9,694. It's because they take their income, all of it is includable in their adjusted gross income. They take that same deduction, their taxable income is $84,652, which fills up the 10% bracket, mostly fills up the 12% bracket, and ultimately leads to a total tax of $9,694 at the federal level. But if we go back to this, remember we're in California, if we scroll down here, we can see at the state level, they are also paying an additional tax. And that tax, once I scroll all the way down, is $2,964. If we add up state taxes and federal taxes, they're looking at a total tax bill of $12,658. So I hope you can see the impact of this. Of both of these scenarios, same exact income. The difference is over $12,600 in taxes between if you just had that income from Social Security versus if you just had that income from IRA distributions. So it's the first way that you can minimize taxes in retirement. Well, in an odd roundabout way, maximizing your Social Security income relative to other income sources can be an excellent way to decrease your tax bill in retirement. The second strategy you can implement to reduce your tax bill in retirement is called tax gain harvesting. Now, most people are familiar with tax loss harvesting. Tax loss harvesting is a good way to sell some investments at a loss, simultaneously buy a similar but not identical security so that you maintain your market exposure, your investment exposure, while still locking in losses that you can use to write off against other capital gains or up to a portion of your ordinary income. Tax loss harvesting is good, but when you are retired, tax gain harvesting, for most people, becomes much more attractive. And I say that because depending on your situation and the makeup of your investment accounts, tax gain harvesting could make a significant portion of any brokerage account you have tax-free, in many ways operating much like a Roth. Let me walk you through an example of how this might work. Let's assume that you are single, you're 65 years old, and we're going to use 2024 numbers. You're pulling $30,000 out of your traditional IRA, and you've not yet started Social Security. So $30,000 is coming from your IRA. Let's also assume that your target income for the year is $50,000. So you pull that from your brokerage account. And in your brokerage account, you have $500,000, and the cost basis on that is $250,000. So to keep it simple, let's assume you purchased an investment at $250,000 and it's now worth $500,000. So what do? We say, okay, I have $30,000 from my IRA that's creating income for me. Social Security hasn't kicked in yet, so I need to sell $20,000 of my brokerage account assets to free up cash to supplement this $30,000. Well, when you sell that $20,000, half of it is gains, long-term gains. The other half of it is your own principal. It's what you use to purchase the stock. So $10,000 of that would be subject to long-term capital gains taxes, and $10,000 of that would simply be a return of principal. So you as an individual, you get your $50,000, but let's look at the tax impact of that. And you can see that right here in this column right here, tax gain harvesting, sell $20,000. What have I plugged in? I've kept it fairly simple just to isolate the numbers we're going to talk about. Here's that $30,000 of IRA distributions we talked about. So that's taxable. You're taking that. You do not have any Social Security that we're counting on quite yet, and you have $10,000 of long-term capital gains. So remember, you sold $20,000, half as a return of the principal you already had, half as a long-term capital gain. Well, let's look at your tax report here to see what the tax liability would be. In this case, your total income is $40,000, $30,000 IRA, plus $10,000 long-term capital gains. You have a standard deduction of $16,550, which means your taxable income is $23,450. Now here's how that taxable income works. $13,450 of it is subject to ordinary income rates. It's a portion that's coming from your IRA. The difference of $10,000 between this number and this number, it's not showing up on your marginal tax brackets at the ordinary income thresholds because it's subject to long-term capital gains tax brackets. So at long-term capital gains tax brackets, you can see here's your total taxable income. You're under the long-term cap gain threshold of 15%, meaning you're at the 0% long-term capital gains tax bracket. So to tie this all together, yes, you are paying some taxes. Here's your total tax liability of $1,382, and that's simply 10% of the first $11,600 of ordinary income that you had, plus the difference between $11,600 and $13,450, subject to a 12% federal tax bracket or federal tax bill. But at the long-term capital gain rate, so that $10,000 of gains you realized, that's taxed at 0%. So Joe sees this and he says, hey, this is awesome. If I can realize gains, let's realize all of them. I've got $500,000 in my brokerage account, $250 of which is gains. Let's just realize all of that and do so tax-free. So we say, okay, Joe, let's take a look at what that looks like. Here's that scenario here in the second column. All else is the same. $30,000 in income from your IRA, that's the same. If we sold the entirety of your brokerage account, you're now incurring $250,000 of long-term capital gains. In his mind, and this can be very confusing, he's saying, well, great, I'm under the threshold, that should be taxed at 0%. Well, kind of, meaning part of it is taxed at 0%, but now all of a sudden, look what happens. Now, Joe, your total income is $280,000. You still have the same deduction. Your taxable income is now $263,000. What hasn't changed is your ordinary income tax bracket. It's still the same $13,450 that you are paying ordinary income taxes at. The difference and what has changed is twofold. Number one, you're down to 15% federal tax bracket for long-term capital gains. And to be clear, the first gains that you realized up until $47,025, those were taxed at 0%. So it's still a progressive tax rate where anything under that is taxed at 0%. Anything between $47,000 and the $263,450 he has, that is taxed at the 15% bracket. But that's not it. On top of that, he is now above the threshold where he is subject to net investment income tax. This is an additional 3.8% surcharge on a lot of his income, the income from investments. So yes, he's now in the 15% tax bracket, plus an additional 3.8% taxes for the net investment income tax. Plus, if we look at his Medicare surcharges, he's now in the second highest Medicare surcharge tax bracket. It's not technically a tax bracket, so I shouldn't say that, but his premiums have been adjusted upwards, and you can see how he's paying about $450 extra per month now for his Medicare surcharges or his Medicare premiums than he otherwise would have. So we showed this to Joe just to illustrate the point of, yes, you're in a 0% tax bracket. That doesn't mean we can go crazy and then realize all of your gains without suffering some consequences for that. So what do we do? Well, we start by saying, Joe, let's go back to what your tax bracket would look like if you realized no gains. Okay, so here's that tax report. The $30,000 from your IRA, same deduction. Here's the same total tax that you had the first time around, which is the tax that you'd pay on the ordinary income you have here, the ordinary taxable income of $13,450. What we want to understand is what's the difference between your current taxable income and the top of the 0% tax bracket or the bottom of the 15% long-term gain tax bracket. Well, that is $47,025. So what we want to know is the difference here. And the difference between these two numbers is $33,575. So we said, Joe, the right amount to realize here, to pay zero taxes on this, because we're fully going to fill up the 0% tax bracket, is $33,575. Now, here's what that doesn't mean. That doesn't mean sell $33,575 worth of stock. Because keep in mind, every dollar of stock that we sell, 50 cents of that is tax-free, because that's your own money coming back to you. 50 cents of it is a gain. So effectively, we need to double that. We want to realize $33,575 in gains, which means selling double that in the amount of stock that you actually have to sell. So let's come back to the analysis here. In this scenario 3, the appropriate way to do it for Joe, what we saw is the same thing, same IRA distributions of $30,000, same assumptions for everything else. The difference is for Joe, we're going to incur the right amount of long-term capital gains of $33,575, which, as I said before, means we're really selling a little bit more than $67,000 of stock. Well, if he incurs this much in gains, here's what that tax report looks like. Total income, here's his deductions. Ordinary income tax does not change. What does change is we have now perfectly filled up the 0% tax bracket. Now, here's what we told Joe next. He said, well, that's great, but we just sold $67,000 of stock. I only needed $20,000. What do I do with this $47,000 extra dollars? This doesn't really do me any good if I'm just spending it, because sure, I saved on taxes, but now I'm depleting my portfolio more than I need to. Well, here's the beautiful thing. That extra $47,000 or so of stock that Joe sold that he didn't need, we could turn around and repurchase the same exact investments he had. And by doing so, if here was a cost basis before and here was a total value, we can slowly but surely, year after year, increase the basis on that to the point that any future sales would not be subject to quite as much in taxes. So there's no wash sale rule for tax gain harvesting like there is for tax loss harvesting. In doing this and managing this appropriately, and by the way, we do need to be mindful of state taxes. Depending on the state you live in, this may not be tax-free, but if we do this intelligently, it's a way of taking that brokerage account and minimizing a lot of the taxes that otherwise would have been due on it. So that's the second way you can save quite a bit of money in taxes throughout retirement. The third way that you can save money on taxes in retirement is through strategic income shifting. Let's walk through another example so I can illustrate what I mean by that. I'm going to use Joe again for our example, and this time we're going to assume that Joe is currently collecting Social Security of $2,500 per month, or $30,000 per year, and we're going to assume that Joe has exactly $1 million in his portfolio. $500,000 in a traditional IRA, $500,000 in a Roth IRA. Income shifting is just the art of understanding where should income come from. Should it all come from the IRA? Should it all come from the Roth IRA? Should it be some strategic mix? And I want to show you what that looks like. For Joe, we showed him a few different options. The first was, Joe, what if all of your income came from your traditional IRA? And by the way, Joe wants to live on $80,000 per year. Where he gets that from is, okay, 30,000 is coming from Social Security, and then he wanted to take 5% out of his portfolio each year. $1 million portfolio means $50,000 per year of withdrawals that he's taking. So if this is the first scenario we're looking at, we see Joe is taking $50,000 from his traditional IRA. So 500 grand in his traditional IRA, 500 grand in his Roth. In addition to that, Joe also has $30,000 of gross Social Security. Well, if we run a tax report on that, I'm going to point out a couple different things. The first thing that's very relevant to what we're talking about is this number here, his total Social Security versus his taxable Social Security. As I mentioned before, Social Security is looking at his provisional income, and based upon what his provisional income looks like, that's going to determine how much of his Social Security benefit is taxable. So in this case, 85% is taxable. So $25,500 of his Social Security is added to the $50,000 from his IRA for total income of $75,500. He takes his deduction, here's his taxable income, and what you can see is that puts him up into the 22% marginal tax bracket, federal marginal tax bracket for ordinary income rates. Total tax, keep this number in mind, $8,022. So call it $8,000 taxes in that scenario. The next thing we want to look at for Joe is, okay, what if instead of taking the full $50,000 from the traditional IRA, what if we took it from your Roth IRA? Let's show you what that might look like. So here's that scenario, all Roth. You can see here, no IRA distributions, no traditional IRA distributions, I should say. The Roth is completely tax-free, so it's not going to show up here. But what is going to show up is his Social Security still. So that's still included on his tax return. And as we look at a tax report here, I'm going to start with that Social Security piece again. Here's what that looks like for him. Social Security of $30,000, but now $0 of that is taxable. Why is that? Well, Roth IRA withdrawals are not included in Social Security provisional income. The second thing to know is half of your Social Security benefits are included in provisional income. So if $30,000 is the gross distribution, $15,000 is the amount that's included in provisional income, which is under the threshold at which $0 of Social Security would actually be included in the taxable Social Security amount. So Joe's total income is 0, adjusted gross income is 0, deductions of $16,550, he's in a 0% tax bracket. Now we said, Joe, this isn't necessarily the goal. At minimum, we want to create enough income to use your full deduction to offset that. But if you remember, if everything came from the IRA, $8,000 was his federal tax bill. What we're seeing now is if everything comes from the Roth IRA, $0 is his federal tax bill. Next, what we want to show Joe is, what if it was half and half? Does that mean your federal tax bill is $4,000? Split the difference if we're just splitting the difference between where income's coming from? Not necessarily. Let me show you why. Here's that final scenario that we're looking at to show you why. So scenario 3, a mix of different assets, $25,000 is Joe's IRA distribution, because now the remaining $25,000 is coming from his Roth IRA. Still the same gross Social Security, and if we run a tax report on this, what we'll see is the following. Social Security benefits $30,000, the taxable amount is $9,600. Again, going back to that provisional income principle. So now his total income is $34,600 minus deductions, total tax of $1,934. So this is important to realize. Going half IRA, half Roth doesn't mean, okay, your tax liability is half of what it otherwise would have been. There's a whole bunch of different factors at play, from provisional income and what portion of your Social Security is then taxable, to marginal tax brackets. And now more of your income is subject to the lower tax brackets and less is subject to the higher tax brackets. So this is a key point to understand with retirement planning. It's not saying that you should take half from your Roth and half from your IRA. The specific numbers here are just for illustration. What it is saying is you should be very strategic about where you're pulling income from. And you should understand the different consequences of taking money from different places and what that's going to mean both for today as well as the long-term viability of your plan. Now here's a key takeaway that I need to emphasize here. The goal of tax planning in retirement is not just to minimize taxes this year. The goal should really be to see how do you minimize your lifetime tax liability, which is part looking at today, but it's also looking at the future and every year in between. So while these strategies can be incredibly powerful, the risk is sometimes getting too short-sighted with them and losing out on what that means long-term. Now, one of the key things to this, and one of the things I talked about first, is one of the best ways you can minimize taxes in retirement is by optimizing Social Security. Well, if you're wondering what can I do to optimize Social Security, I made this video here where I talk about 4 simple things you can do to optimize your Social Security benefit, which helps to maximize your income and could also help to minimize taxes. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.